you come into today talking about how a lot of the geopolitical tension has eased, what with a trade deal looming and a Brexit in sight. Does this attack on an Iranian militia guard do anything to change your outlook for 2020?
Well, it certainly makes it a little bit more complicated. We did have a lot of known unknowns in 2019 that basically got resolved in a pro-growth fashion for the most part. This certainly throws a wrench in some of that. We don't think it's going to escalate a ton, but it is very early stages, and so it does. Is one more thing that we need to think about coming into the first part of this year.
All right, John, what's your take on what happened in Iraq and how it might play out for your thesis for 2020?
Well, I have to admit, my first thought was I've flown over that airport twice in the last month, and I'm glad it wasn't today. But I think it just illustrates that we are very, very fragile, subject to event risks. And, economy's fine. The growth in the market in the last year has been all Fed, no profits. The profits are not looking very good going forward. So I like the idea of just being careful and being defensive, lest we wake up another morning and find out 3 more things have gone by. That means you'll miss a little bit of the remaining ups on whatever this market is, but that's okay. I'm too old to make this money back.
Well, you're suggesting, John, that the multiple expansion that we had that caused the market to go up as much as it did this past year can't be repeated, that it's not sustainable. Is that what you're saying?
Absolutely. It's entirely caused by central banks flooding the market with liquidity. They can do that. And earlier I heard Steve down from the AEA convention in San Diego. In 1967, Milton Friedman, rest his soul, explained to us that if central banks print money forever, sooner or later prices go up, and sooner or later interest rates go up too. When rates go up, multiples fall. That was the 1970s. So we should be paying more attention to the multiples. And in the world of private equity and real estate, read that as exit multiples. If you're going to be buying something today, make sure that you look at selling it in a couple, 3 years at 1 or 2 multiples lower than we have today.
Scott, I guess another way of looking at it is that profits in the U.S. have basically held flat at record levels in the last year. And obviously, investors are feeling like they can try to handicap a return to growth. Now, today we did get another weak ISM manufacturing number. I don't know if that changes the market's calculus, Scott, but how are you reading it?
Well, I mean, it is again, we are expecting a return to more robust growth this year. Last year, the dominant narrative was everything was late cycle, and that was the investing narrative. That was the market narrative. Everybody assumed that was just the case. It was a starting point. It turned out that we're probably a little bit more mid-cycle than we are late cycle. We had a little bit of a slowdown in the U.S., but things out of China and stimulus from both the Fed and the Chinese, both the monetary and fiscal side last year, are going to start to bear fruits this year. And the market obviously is a discounting mechanism, and so we rallied in the fourth quarter. But that rally is by no means done, we don't think. We think there's plenty more to go, especially in the first half of this year, before we can get to a place where we have irrational exuberance or anything really toppy on the markets.
John, you sort of take issue with the market, saying it's all Fed, it's not sustainable. The Fed's policy, though, is sustainable, and it doesn't look like they're going to do anything anytime soon. Rates are going to remain low. Charlie Evans just said the economy's in a good place. What's there to be negative about?
Charlie Evans said he wasn't sure whether they had enough reserves in order to manage the liquidity issues. Maybe they should have a bigger balance sheet. In other words, we're in QE4 already.
But you're painting a picture even more so why stocks could go up, right?
Yeah, but only temporarily. I mean, printing money is not a panacea for making stocks rise long term. It gives you lower discount rates and higher prices in the short term. I don't think that is sustainable.
Scott, what do you think is going to be the big driver of 2020? Do you think it continues to be whether the Fed keeps the hands off, whether there's liquidity, whether earnings are the driver, as we've seen so many people count on? Or do you think these geopolitical tensions end up being the big what-ifs that come into play?
I do think it's going to be a lot about the Fed and a lot about policy. So the deregulatory policy of the Trump administration doesn't get enough credit for what it's doing to this economy.
Sure.
The change in the Fed, the change we're talking about in the Fed in terms of having more of an average inflation target, is getting not nearly enough play. That is a really important policy shift from the Fed if they go that way. It's, they're trying to prevent this idea that we can't produce inflation even if we want it. That's pushing back against the Japanese model that, we know what that looks like. We know what that model looks like. If you can't produce inflation as a central banker, that's probably the most dangerous place you can be. So the Fed's pushing back against that. All that means, though, it's really important. It means that we're going to have a much more dovish policy stance out of the Fed for a much longer period of time. That's not something that I think you want to fight as an investor.